I'm here to warn you that another bank may collapse next. Which bank am I talking about? About all of them, of course. Banking is always a risky business, Wall Street Journal says. Like many tech companies, my company and some of the startups we've built spent the weekend worrying as the fate of Silicon Valley Bank and its depositors hung in the balance, the author says. And as of Sunday, the Federal Deposit Insurance Corporation announced that everything was fine, no customers would lose money, but on the same day, New York regulators shut down Signature Bank over liquidity issues similar to those that broke up SVB. And as expected, the backlash has already begun. This is by Nathan Myhrvold from the Wall Street Journal, and I'm translating this from a Greek article. He says, I'm here to warn you that another bank may explode next. Indeed, almost anyone reading this may be at risk of losing anything beyond the FDIC's $250,000 deposit insurance limit. Which bank am I talking about? For all of them, of course. The fundamental business model of banking is that the bank accepts money from depositors and then invests almost all of it. Banking laws stipulate that a certain amount of depositors' money requires reserves, usually about 15% of the total, must be held to redeem customer accounts. The remaining 85% is borrowed, often in long-term illiquid loans. If customers want to withdraw more than the bank has in reserves in a short period of time, a death spiral can ensue. At this point, the bank essentially has two options. The first option is to raise money by selling investments. Selling investments at a loss, however, could push the bank closer to the point where it cannot honor customer withdrawals. Other customers who watch this will start to worry. The second option is to try to raise enough money to bridge its cash needs by selling shares in the bank itself. But doing so requires telling prospective investors details about the bank's condition, which can paint a picture of an institution in trouble. Silicon Valley Bank did both. It sold $21 billion in long-term bonds at a loss of $1.8 billion. That sounds like a lot of money, but it's just under 1% of the roughly $209 billion it had in assets. SVB also sought to raise $2.5 billion in equity investment to help cover that loss. And its executives appealed to the venture capital community, which represents a huge chunk of its client base, for support. The latter looks like an injured zebra who appeals to the kindness of the local hyena tribe. The result was a bank crash. Banking is based on probability theory. If you have a large number of account holders and each of them makes independent decisions, then you are unlikely to ever have a problem. One account holder may need to take out their money to meet their financial obligations, but while this is happening, someone else's business is booming. The second keeps money in the bank and can even deposit more. On average, thousands of independent depositors' decisions leave a relatively smooth and predictable trend in the demand for the bank's assets. But statistical independence rarely exists in the real world. The state of the overall economy tends to affect all bank customers in similar ways. Worse, rumors of bank failures and increased risk of losing money can run through the customer community like wildfire. Instead of a steady, predictable increase in withdrawals, there is a frightening spike. Each of these factors happened last week with Silicon Valley Bank, but it's nothing new. A bank in the town of Bedford Falls in the focus of Frank Coppola's 1946 classic It's a Wonderful Life. Excerpts, this is the picture that we have here, excerpts of which were emailed to tech companies last week. In the film, Uncle Billy triggers, I'm sorry, I shouldn't laugh. In the film, Uncle Billy triggers a crash by losing $8,000, which was expropriated by the greedy robber Baron Henry Potter. The number of zeros has increased over the decades, of course, but the dynamics are the same, including the national tendency to blame a single bad guy like Mr. Potter. The politicians and the media are already starting to search for a villain in the Silicon Valley's bank story. They might find one, but it seems more likely that some screws in the system have come loose unexpectedly. The FDIC, the Federal Deposit Insurance Corporation, and strict government regulation of banking were created in part to prevent bank defaults by reassuring depositors with government guarantees, but that's a fool's errand in our highly connected world. Any bank could collapse if a large enough portion of its customers panicked. Even Signature Bank, whose board of directors includes former Congressman Barney Frank, principal author of our main banking law. At best, the FDIC can help clean up the mess after the fact, and where necessary, the feds can step in to guarantee all deposits, as they did this weekend for SVB and Signature depositors. This is important since the entire banking system, and with it the economy, of course, is a game of odds. If the bank failures are independent, say building a loan collapses because of Uncle Billy, this is troubling but limited in scope. But the economy is interconnected, and bank failures, or even the threat of them, in one sector can bring down others. A crash in a single bank is tolerable, but a run on the system can suck all the oxygen out of the economy, as happened in the Great Depression. It almost happened again in 2008, when a crisis of confidence nearly caused a global financial meltdown. Banking is a trust game. It's really the only thing that keeps the model going. But the problem of keeping the faith is becoming more and more difficult. Panic spreads much faster today than it did in Bedford Falls in the 1940s. Bedford Falls is a fictional town in which Philip Van Doren Stern's 1943 short The Greatest Gift and the film adaptation RKO picture 1946 is It's a Wonderful Life movie. I can honestly speak for every bank that is at risk, mainly because I am not the boss. If Jamie Dimon or Jerome Powell said the same thing at the wrong time, it could trigger a financial crisis overnight. I wish there was an obvious solution for this problem, but there isn't. Tightening reserve requirements, as the Federal Reserve sometimes does, makes it harder for businesses to get loans. This hurts the economy and reduces the interest deposit holders earn on their money. Increasing regulation in general will tend to make banks more bureaucratic and less responsive to their customers. A major reason why Silicon Valley Bank was so popular in the technology industry is that it better understood the needs of new technology companies and startups in particular. Would a more government-controlled bank do this? Probably not. Even if there is no solution, it's important to keep in mind the basic volatility of banks. Otherwise, we risk well-intentioned interventions being worse than the problem. Banking experts and regulators are like TV weathermen. For all their abilities to predict what will happen in the short term, they are still surprised. And they don't actually control the weather itself. Sometimes, unexpectedly, a perfect storm comes along. This is by Mr. Meervolds, and the founder and CEO, Intellectual Ventures. It's from a Greek article I transferred it for you. Please leave your comments, and thank you for your support. Kindly support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support, and that you find all my content so interesting. You'll find the Patreon account details in the description box